Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we're going to be talking about interest rates. The Fed just cut interest rates, and we wanted to bring you the information around the expectations of what that means, how much they cut it, and then really how to react. What should you do? But before we dive into today's episode, Mr. Collins, you, as you just cracked open a lovely beverage, are having a beer, and I have forgotten one. So I'm going to just toss it to you. Hazy IPA, shocker, but what's the brand there?
Stone.
Stone. Oh, Stone's good.
Yes.
Stone is good.
Well, and like a shout out to a local brewery. I'm drinking it out of a scuttlebutt glass.
Mix and match. We got the
Yeah.
scuttlebutt glass with the Stone Brewery. I love it. Love it. So, well, if you haven't tried Stone, a hazy IPA, definitely go try it. They're out of, why am I thinking California? Yeah. Yeah. So great brewery. Check them out. You got the,
trying to figure out what city or whatever. It's not telling me what city.
All right. Well, either way, good beer, good brewery. Check them out. So, cheers, Mr. Collins. Clink. So, well, Alex,
that's delicious.
I'm not gonna lie, I'm a little jealous right now. Focus, Ryan. Focus. All right, Alex, why don't you enlighten everyone? What happened? What are the expectations that the Fed led everyone to believe, at least here?
Sure. So the Fed cut the Fed funds rate by, which is like the rate at which banks borrow from the Fed, by 25 basis points or 0.25%. What that means is that interest rates are coming down. They furthermore said that we're likely going to see somewhere in the neighborhood of another 0.5% to 1% cut over some period of time. They were still kind of vague about that, which doesn't surprise.
They're always vague, so that's nothing out of the norm.
Yeah, I mean, what they're trying to do is they're trying to get the market to move without actually doing anything. That's generally speaking what the Fed's trying to do. And we've like, this was largely anticipated. This isn't like, there's no like, oh my God, what happened? No, like this was largely expected. We were just down at Future Proof in Southern California, and this was talked about quite a bit down there. So it's all in all, it should be relatively good news for the markets, for consumers, etc. And we're going to walk through like kind of the two areas that we see it like largely impacting our clients and talk about it from a planning perspective.
So let's get into that planning perspective here. So, people hear, oh, the Fed cut interest rates. There are a couple things they're probably thinking. One, how does this affect their savings account, right? So let's kind of start there. Cutting the interest rate, obviously that's going to affect the savings interest rate that you're getting on your money, and it's going to come down, right?
100%.
How quickly it comes down, we'll see. But the fact of the matter is it's probably going to come down. And you and I always have this conversation around, like, we want to make sure we're not chasing, like constantly moving banks to chase return, like who's got the better rate of return. But you should be questioning yourself. Are you getting the market-based interest rate on your money?
We've had, I think we've mentioned it on here a bunch, but there was a banker client a few years ago that was talking about the interest rate that they were offering as 0. nothing. And like, there's still a lot of banks out there that, like, if you're in their primary checking or primary savings, it's still 0. nothing, even though you can get very significant rates of return elsewhere. So what we want clients to do isn't run out and chase rate of return, but at the same time, it's go Google it and make sure that you are getting a comparable rate of return for high yield savings. And like, we constantly get asked, which one's the best? There's no right answer to that. Like, make sure it's FDIC insured, make sure that like it's a bank that you're comfortable with and you're familiar with. And beyond that, it's mostly personal preference and access.
Yeah. So the takeaway, just to repeat what Alex just said, is again, make sure you're getting the market based return. Don't be chasing it. If you're already getting a 3% rate of return, a 3.5, like we're not sure that you should be changing banks. Now, if you're getting like 1.5, that might be a different conversation for you to go look at. Okay, does it make sense to have, a large sum of money there? But make sure you're going to a bank that is FDIC insured and it's a bank that you feel comfortable with, right?
100%. Yeah, 100%. And like when we start getting into anything that is sub 3%, like where it's now expectations are that the inflation is going to be bigger than what you're getting, like that's the time to come have a conversation with a financial planner, to go ahead and see, hey, what are the alternatives? Now, at the same time, we still want to make sure that we're in a promise based asset as opposed to a market based asset, meaning that the value of the account is based on a promise and usually a guarantee, as opposed to something that is going to fluctuate up and down with the market, whether that's the stock market, the real estate market, the bond market. Anytime you've got something that can change with the opinion of others, that's a market based asset.
And I'll just throw in there the the promise without fees, right? There's certain tools out there that there's a promise, but if you take it out at a certain time period, maybe there's a fee attached to it. Again, we're talking about money that is an emergency fund. We're talking about money that, and not emergency as in negative, and also might be a positive. Money you might want to touch for whatever the reason, and you don't know when that's going to happen. That's the money we're talking about right now.
100%. And from a planning standpoint, the amount of money that we're recommending in this bucket does not change based on interest rates and things of that nature. Now, the location of where exactly it sits, that might change a little bit. And that's why I was suggesting anytime you go below inflation rate, right now, somewhere in the neighborhood of 3 to 4%, that's when it makes sense to sit down and have a conversation, whether it's with us or somebody like us. Make sure that you're having that conversation with a financial professional.
And keep in mind, we're recording this on Monday, September 22nd. When this gets released, that interest rate may have changed. So just again, this is where you do your due diligence, do some research, kind of look at what the average is going out there. That's how you kind of determine what the market-based return is.
Well, and if you're listening to it in 6 months or a year or 2 years or 5 years, it's all the same stuff, right? So
Yeah.
it's all relative. And what we're trying to do is we're trying to give you the guidelines of make sure that you're at least getting market rates, make sure that you're getting close to, if not above, inflation numbers. And if you aren't sure, seek help. Find
Yep.
a professional to work with that you know, that you trust, that knows you, and can help you get the right answers.
Yep. So the second part that I think our clients and people that listen to this podcast are going to care about is, what does this mean for debt? Right. And I
Yeah.
think they're thinking of either getting a new mortgage or refinancing mortgage or refinancing debt in general, right? Maybe car loans, that kind of stuff. So how is this going to affect the actual public here, Alex?
But well, I mean, like, I don't know about you, Ryan, but I've gotten like 3 or 4 calls already from folks that are trying to like compare, hey, I'm being offered this or I'm being offered that. Like the terms are different. And like you and I come back to like everyone wants to compare interest rates, and interest rates matter 100%. However, what matters actually largely more is cash flow. And so when we're comparing two different strategies, you're going to wind up with about 4 or 5 different variables. We're going to need to make some assumptions on it. And you need to be able to make sure that you're doing good comparative analysis to figure out, okay, which one makes the most sense. Like when I was doing this with a client the other day, they were they were thinking that like the lower interest rate over a shorter period of time made more sense. And when we actually calculated it, we were looking at it going, nope. It like now it's possible that we didn't have exactly the right numbers or something, but the longer payment period with a little bit higher interest rate made a huge difference to them from a cash flow standpoint. And it wound up being way less cost to them over in that case, 4-year time period that they were going to be buying the new car. They actually wound up going with a 5-year option with the idea that, like, hey, at the end of year 4, they're just going to cut a check for whatever the remainder is. Like, no big deal.
I don't. More and more, especially with car loans specifically, right? Because you can still get, even today, you can get the 0% interest finance. Maybe it's the 1.9 or 2.9 interest finance. More and more, now this isn't a blanket statement. So let me put the compliance piece in here real quick. But me personally, if I'm going to go shell out $50,000, $60,000, doesn't matter the dollar figure on a car, and the interest rate is 1.9%, I'm going to get the loan that's 5 years and just pay the monthly payments, even though I've got it sitting in cash.
It's arbitrage.
I'm going to arbitrage it. And by arbitrage, like, I can take that money that I would have given the dealership instead. And if I can get 3% rather than 1.9, why wouldn't I get 3%?
Yeah.
Right? Simple. It always comes down to cash flow. And this is just a plug for an episode that Alex and I did. It was around refinancing or overpaying mortgages. It's episode number 306. And then we had a secondary episode to follow up and look into the weeds of it. And that's episode 307. Check those 2 episodes out, because if this is what you're analyzing, like, should I do car loan or should I do refinance? Like, we do a really good job of explaining the arbitrage or how to look at the cash flow in that episode. So again, episode 306 and episode 307 are the 2 episodes to go look out for that. It always comes down to cash flow. And this is what we say in almost every episode. Like, I know it is probably sounding redundant, but for those of you who have been listening to us, and for those of you who are brand new listening to us right now, the only thing we all care about is the money that we get so that we can live our life. And that's today and into the future.
Well, and
that's how we should be looking at it. That's how we should be planning.
And to touch just on a real high level on, like, the possibility of refinancing, when it makes sense to refinance, one of the other things that you have to ask yourself is, hey, if rates continue to go down, am I okay refinancing again in 6 months, a year, whatever that is? And that decision shouldn't be impacted based on what you're doing today. You won't know whether it's the right decision to refinance today, given what the market may do in the future. The only thing you can do is say, hey, it makes sense today to do this. Now, the next question is, do we want to do it now, or do we want to wait to try and see if things get better? And that's an individualized conversation of, like, hey, what's your risk tolerance on, like, if rates bounce and go back up, or
and
whatever
what's your
else.
goals? Like, if you have a near-term goal as well, like, that's another aspect. So, like, there is no
100%.
blanket answer to what you just said. This is why it's individualized, because, sorry, people listening, I don't know your goals to make this personalized to you. However, we're giving you the concepts and stuff to consider to help you make those decisions.
Wait, we can't personalize a podcast to 50,000 individuals?
No.
So, I mean, it's like the whole point and purpose of this is trying to give you the tools and trying to give you the conversations so that you can then take that information and apply it to your situation as best you can, or take it and go find a professional like us who can help answer these questions for you.
Absolutely. So that's what we got for you today. Easy, quick, hopefully you got some value out of it and you can take to your own personal situation. Check us out on beerandmoney.net. At the top right-hand side of that page is a contact us button. That's a great way to reach out to us with any questions that you have. Or if you have a suggestion for us, that's a great way to reach out to us. Also, in the show notes, make sure you check out the YouTube link. Like, specifically for episode 306 and 307, we go into the numbers in that, so you can see those numbers live. So check out the YouTube channel for that. And then lastly, we've got a newsletter out there that we send out once a month. And so in the show notes here, you'll see the link to sign up for that newsletter. Like, we started this podcast to help you think differently about your money and to help you hit your goals. So we hope that's helping you. Mr. Collins, Appreciate your time. And as always,
cheers. And if you have a beer suggestion for us, drop us a line and say, hey, you guys should check out this beer.
Yes, do that.
Thank
Cheers
you.
again.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
8423913.1 expiration date September 2027.